to look at the economic challenges facing China. I'm joined by Frederic Neumann, co-head of Asia Economics Research for HSBC. Frederic, thanks for joining us today. Inflation, as Stephen said, #1 priority for the Chinese. The question is, how do you tackle inflation? In your notes, you say reserve ratios. That's the tool of choice.
That's a tool of choice. I've already used some of it, but there's still a long way to go. We really want to squeeze banks and encourage them to cut back on lending. That's, I think, the critical part. Last year, we still had fairly robust lending growth. This year, the name of the game is to slow it down, and part of that strategy will be to raise reserve requirements rather than interest rate hikes.
Why aren't interest rate hikes so effective?
Because the trouble is, if the Federal Reserve pumps some money into the global economy, you raise interest rates in China, that signals that monetary policy is tightening. It draws in capital, and that actually negates the tightening effect. And China does grapple with hot money inflows. That's one of the, I think, the challenges that China faces. So you try to tighten without raising interest rates, a very difficult thing to pull off, but that's the primary strategy.
But still, you are forecasting a couple of hikes in interest rates in 2011, yeah?
Yes, we are. But the interesting thing is the hike in interest rates is not so much like in Western economies to raise the cost of capital for firms. That's what you use RR for. But it is to raise the deposit rate for savers, because their real deposit returns are now in negative territory because of high inflation. And you want to encourage them to leave the money in the bank and not take it out and buy property, and therefore fuel inflation further. And that's why you raise interest rates a little bit.
Since June, the yuan has risen around 3%. How much more and over what sort of time period will China allow it to rise?
We really think it's continuing at this pace, no dramatic changes. And one of the issues with inflation, strangely enough, is that a stronger yuan could now actually fuel inflation in China because it attracts more capital in. And so the Chinese are trapped a little bit. Textbooks would tell you that you need to appreciate the exchange rate to cool growth down. But in this environment, with the Fed pumping liquidity into the global system, if you appreciate your exchange rate, you're just fueling more capital inflows, and that could actually fan inflation as well.
But imported prices of commodities will decline. But of course, commodity prices elsewhere will rise because China is a voracious appetizer of commodities. So it won't solve the commodity price conundrum, will it?
It wouldn't, and it would actually make it worse for the rest of the world, because if China appreciates its currency, it's actually going to demand more commodities. They become cheaper in China. They demand more, and then the price of oil, etc., goes up even further.
Asset bubbles, I know it's a subject close to your heart, and we're looking closely at the issue, not just with China, but the rest of Asia. And in your report, you say a number of options are available to Asian authorities. Do nothing, raise rates, allow currency appreciation, impose capital controls, tighten macroprudential regulation, tighten fiscal policy. But a mix, you say, is the best solution.
It has to be a mix. There's no silver bullet to prevent asset bubbles. And it's not just about asset bubbles, it's about inflation, and it's about excessive investment over time. And Asia has phenomenally loose monetary policy. We need to tighten up. Otherwise, we'll look at the rerun of what we see in the United States, for example, where loose monetary policy fueled an asset bubble. And Asia is at risk of going down the same road.
The traditional economic notion that tightening rates is the nirvana to solving problems, it's dissipating now, isn't it? It doesn't seem to work.
It's in a globalized world very difficult to do. If Korea raises rates and the Fed keeps rates on hold at zero, that's not going to tighten monetary conditions in Korea. So we have to become more creative. We use all tools in the arsenal to really address this problem. And fiscal tightening, for example, would be one option, but so far nobody's talking about that.
Do you think they will start to talk about it? I mean, is that on the agenda for 2011?
They better do so fast, because we evidently have inflation problems already creeping up on us.
Frederic, thanks for joining us today.